Hey guys, great to see that the market's picked up in November, isn't it? Even with the ongoing wars going on around the world. Hopefully this is the start of a Santa rally with something even bigger to follow, but time will tell. Are you back in the markets yourself, or are you still on the sidelines? Our real money, real-time ASX Stocks portfolio is in the market, and it did pretty well in November. By sticking to this trend-following swing trading systemised process, we were able to achieve 4.43% positive growth for the month of November. These are the 9 stocks that we currently hold in our portfolio. As you can see, there's some nice juicy profits, and there's also some in the red too. We run this portfolio in real time with real money, so there's nowhere to hide. We'd rather put it all out there, warts and all, so you can see everything as we go along, the profit trades and the loss trades. And because this particular portfolio mostly invests in large household name companies, you can see some of the stocks we're in also have a great dividend yield. Now, while we don't trade for dividends specifically, as we're looking for more growth, they are a nice bonus when they do come along. So with things starting to turn around, at least for now, if you're out, you may be wondering whether it's time to get back in. Now, while I can't tell you the future, there are a couple of things to ponder and make plans towards if you do decide to go back in. I guess the first question worth answering is, why did you pull out in the first place? Is it because that you just felt that the market was going to go down or sideways for an extended period of time? Was it from reading commentary in emails, on forums, listening to podcasts, or have you been spooked by some market guru or expert that, the ones that picked the last big market crash and they said it was going to happen again? Were you spooked by one of those? Or was it because you've got a market risk decision-making process already in place that told you to sell up and you just followed it without emotion? If you don't have the very specific decision-making process in place and you just felt like it was going to happen, was the feeling that got you out of the markets just a bit of a gut feel? Was it completely random, or was it more of an intuitive feeling? If so, will you trust the same feelings again next time around? And then what actually defines the next time? If you've pulled out of the market, do you realise that you've stepped out of the game and you've become a bit more of a spectator? You've actually gone and removed yourself from the opportunity flow of the market that actually provides you with the opportunities and the profits. And if you are still out, what criteria will get you back in? Will the reasons you get back in be consistent with the reasons why you got out in the first place? Will they be the same reasons that got you back into the market the last time you got out? That is, were your decisions consistent? Big dilemmas, right? The constant uncertainty in trying to read where the market's at, then trying to make decisions around that. For many, it's an ongoing battle that they struggle with week to week, year after year. Sometimes the market's tough to read, and sometimes it's downright frightening, isn't it? Mark Douglas, one of the world's leading trading psychologists, said in his book Trading in the Zone, "I don't think I could put the difference between the consistent winners and everyone else more simply than this. The best traders aren't afraid." That's in chapter 1, page 11 of Trading in the Zone. At Sharewell Systems, we like trading mechanically because we don't have to make those constant decisions week after week, year after year. We don't have to be afraid of our decisions and what they'll mean to our future. The system and process do that for us, telling us what to buy, when to buy, how much to buy, and importantly, when to sell to lock in profits or to cut losses short. And we just follow it flawlessly. On top of that, they also tell us when to get out of the market altogether and when to get back in. So there's no second guessing, just a plan and process that we follow consistently at all times. It makes your investing life so much simpler. Last year, for instance, financial year 22 to 23, our real money portfolio gained 15.32%. That was a great effort in a year where interest rates were soaring and people were backing away from the market. Our mechanical process and statistical edge kept us confident in our beliefs about the market. It gave us the mental fitness to keep trading in tougher conditions and block out all the noise. Now, I said this last month and I'm going to say it again because it's so important. Being successful in the market is about winning the psychological game. It's what's between your two ears and how you react to the different curveballs that the market throws at you that'll determine whether you come out on top or whether you end up as just another market victim. No portfolio will ever go up in a perfect straight line, and nor should you expect it to. Whatever investing strategy you follow, you want to be confident enough in it to be able to ride out the inevitable short-term volatility to beat the market over the long term. If we go back and look at the last financial years, for instance, we can see that our portfolio has grown 89.66% or 13.64% per annum. That's compounded per annum. The market, the ASX 200 Accumulation Index, which tracks the performance of the largest 200 companies on the ASX and also includes their dividends along the way, has only grown 40.65% or 7.05% per annum over those same 5 years. This equates to tens of thousands of dollars less than our portfolio in just 5 years. Sure, there have been some ups and downs along the way. There's been bumps, including the big market pullback during COVID, where the market fell 35% and our portfolio got out. We just moved to cash. But overall, after all the ups and downs, the positive and negative news, the wars, the floods, fires, changes of government, changes in policies, and a virus that shut down most of the world for a couple of years, we've remained vigilant. We've stuck to our process and grown our portfolio 89.66% and achieved an average return of 13.64% compounded per annum. And we've done it with just 15 minutes per week of effort, staying consistent with the right mindset to keep on keeping on at all times. Since taking our first trade at the start of 2016, starting with $80,000 right up until the 30th of November 2023, our real money ASX public portfolio has grown 135.85%. It's now worth $108,667. The market, on the other hand, has only grown around 80% in total over that same time. As I said, a few extra percent per year of outperformance has equated to tens of thousands of dollars more in our portfolio in just 8 years. When you get the process and mindset right, it's a much more enjoyable and peaceful journey to hitting your investing goals and getting you closer to where you want to go faster. Your portfolio balance and your stress levels are much happier too. And I'm sure you'd agree, we could all do with a little less stress in our lives, couldn't we? So if you want to keep up to date with all the new positions that we've bought or sold off in our portfolios and learn all the ins and outs of trading the stock market with a system, then subscribe to the channel and tap the bell to get notifications for all the latest. And if you'd like to try out our way investing for yourself, you can sign up absolutely free to our 7-day systemized investing challenge, where you can learn the simple process for yourself using our actual system for buys and sells, getting a bunch of market education along the way, and learning what it takes to become a consistent and peaceful investor. You can sign up for the challenge in the description below, or you can register on our website, sharewealthsystems.com.au. As always, this video is for education purposes only and shouldn't be taken as specific advice to buy, hold or sell any position in the market. And of course, the past performance is not an indication of future performance. Until next time, when I look forward to showing you around the markets again, I wish you consistent, objective and peaceful investing. Bye for now.